Everyone, it's Paul with the Tuesday Bold Profits video. So as I'm always now in the habit of doing, to give you disclosures, warnings, disclaimers. One is that this channel exists to promote investment newsletters for Bold Profits, which is the publishing company that backs me. We've got 8 investment newsletters. 6 of them are on various kinds of stock market investing. 2 of them are in options investing, and we've got a 9th one coming for a crypto trading service. And we focus pretty much exclusively on what we call America 2.0, fourth industrial revolution. To the outside world, they might call it growth stocks, and that's actually going to be the subject of this week's video. So just hang on for a bit when I go through the rest of these disclaimers and things like that. The second thing is that any ideas that we talk about on this channel are definitively for the longer term, minimum of 1 to 3 years. And I absolutely stress the minimum. And I'm bringing this up because we've gotten in the past a lot of feedback from people who have misunderstood the nature and character of our ideas and want instant performance, or when the price of something that they have heard about, watched about, they went and bought and it went down and then they were angry. And our timeframes are much longer, minimum 1 to 3 years. For example, in our Profits Unlimited newsletter, which is our sort of introductory flagship newsletter, which goes for about $49, which if you're interested in, you can click on the strong hands above or go to the link below and it will send you to a page that will allow you to subscribe. We've still got the stock that we put in as our very first stock pick, which is ST Microelectronics. We've made something like 400 or 500%, and I still believe there's upside, so we continue to keep it. So that's how long potentially we can stay in ideas. So long term, and we ride through volatility. I disbelieve completely in trailing stops and trying to control volatility. I believe that if you're in a great bull market, you should stay in it because you make the money by being in. So that's number 2. The third thing is that you will see if you go through our comments regularly that there are bots out there, artificial intelligence bots, that are trying to scam you and take your money. They'll say that they can manage your money, that some advisor does a great job. Sometimes they use my picture. Sometimes they use my incredible colleague Ian Dyer's picture, or Amber Lancaster, my amazing colleague Amber. And this is all a fraud and it's a complete scam. Anyone asking you for money in the comments of YouTube or on Twitter or on Facebook, any social media on the internet, 100% guaranteed fraud and a scam. Please do not engage with these folks. You will lose your money. You will lose your Bitcoin, crypto, whatever they're asking you for. So with all of that out of the way, I also want to say that if you're a regular viewer and you've enjoyed these videos, consider subscribing and giving us a thumbs up so the Google algorithm favors us. All right, so this week's video, I want to actually answer a question that I've seen posed to me either through Twitter or else actually in our YouTube comments, which is, what is the difference between these so-called value stocks and growth stocks? And after reading the question, I realized that I had never defined this for people. Like, we talk about our stocks as being America 2.0 stocks and fourth industrial revolution stocks. However, the truth is that for many people, they have no idea what those things are because you probably never watched my America 2.0 presentation. And you have no idea what the fourth industrial revolution is either, because still, even in the media or even in social media, this is very sort of like less discussed. It's sort of like there somewhere in the background, people talking about all these new technologies, all of these new mega trends, the Internet of Things, artificial intelligence, blockchain, or new techniques like 3D printing, or the use of lasers, or the coming of new industries like space, precision medicine, this transition we are going through from carbon-based energy to sustainable energy. All these transitions put together, that's the fourth industrial revolution. And these are largely represented in what the investment management world, the money management world, Wall Street as it's referred to, calls growth stocks. We call them America 2.0 fourth industrial revolution stocks. And then there are stocks that really are non-participating largely in all of these new trends, all of these new technologies, and they are generally referred to as value stocks. So today I want to draw the contrast between value stocks and growth stocks. And just to make it clear, we focus exclusively on growth stocks, and even more, we focus on these mega trend type stocks, which are really looking out at the future. All right, so I'm going to start with value, and then I'm going to go to growth. So if you're looking at a value stock, generally speaking, it's based on the financial statements. And many people will be wondering, well, Paul, like what else could a stock be based on? But just give me a minute here and I'll get to growth in a few minutes. All right. It's based on financial statements. It's based on financial statement analysis. What people do is they will look backwards at a company's income statement, their balance sheet, their statement of cash flows, and then come to some understanding as to the nature and characteristic of this business, of its ability to replicate what has happened in the past and the future. Because generally speaking, let's say if you're looking at a product, say like Hershey's chocolate or something like that, this is a company that's been around for a long time. It still gets a great deal of its sales from its original product. So there's a nice stable trend that you can count on. You can also, by looking at the financial statements, come to certain assumptions at the rate at which Hershey's might raise the price of its chocolates and its candies, of the rate of growth that it's likely to experience, being that chocolate at this point is a somewhat mature product. It's been around a great deal. And you come to a series of assumptions around which you can then make some assumptions based on the past for the future. And those are based on three primary financial statements. The income statement, which really has everything about sales and then income. The balance sheet, which is based on assets, in other words, everything from cash to buildings to intangible assets like trademarks and patents. And then there's the statement of cash flows, which is really measures all the different flows of cash that happen within a company with respect to its actual operations. Then there are its investments and anything that where cash is moving from various accounts, that's where it's recorded. So that's number one. It's based primarily and purely often on financial statements. The second is that value stocks are generally selected by people who focus on value stocks based on valuation. And they're very focused on measures like PE ratio, which you may have heard and you might see, which represents price to earnings ratio. So without getting into a very complicated explanation, price in this case represents the actual share price, and earnings in this case represents the total profits of the company, which is generally referred to in the financial statements as net income, divided by the total number of shares that are out there. And now you get something called earnings per share. And what they do is they take the price and they divide it by the earnings per share to come up with the PE ratio. And many value investors are very sensitive. They want PE ratios that are under 12 or under 15 or under 16. Oftentimes, if they can find one for 8 or 9 or 10, and it fits their way of analysis based on the financial statements that I mentioned earlier, that gets them very excited and they want to own these companies. And in the current environment, you can find a lot of these companies among slow growing companies in finance, among the old line food industry companies. Those are considered to be value stocks. Some of them have high PEs. Nonetheless, they fit the previous requirement where based on their financial statements, you can come to some sort of extrapolation as to where their numbers are going to be 1 year out and 2 years out. The other thing that value investors are focused on is they do want their companies to show actual profits. And many of you will be saying, well, Paul, how can you pick a stock without profits? Or how can a company have a value without profits? And I'm going to disagree with that, but I'm going to cover this a little bit in the growth section that's coming after. So this is a contrast because in growth, profits are something that are set aside because usually growth companies are reinvesting back into their company at such a rate that there are often no profits. So this is something that's an issue for value stock investors. They really want to see profits regularly show up now, and any investment that's being made into the company come from excess that are there. The third thing that I can point to in value investing is that people also focused on sometimes what the assets are. And this they do by focusing on something called the price to book value. And the book in this case represents the value of all the assets that's on a company's balance sheet. It can be land, it can be buildings, it could be, in some cases, cash generative trademarks or patents. It could be cars, it could be any asset of any kind. And people are looking to buy this cheap, because when you go and look at a balance sheet, you can see that everything is valued at cost and then it's depreciated. And so you can come up with a book value that's approximately where the value of it might be if you liquidated all of these assets. And value investors are often very focused on things like book value and price to book value and trying to get cheap ones, in the idea that they're getting a bargain. And if they're getting a bargain, then other investors are going to figure this out and then come to bid the price of the company up, or else somebody may come and buy the company out to get control of these assets. So bottom line to value investing is the idea that past trends will predict the future with some amount of certainty. I mean, that's the essence of it. You're looking backwards and you make a judgment based on financial statements, based on a number of ratios, based on that the past trends are a pretty good reflection of what the future and near future is going to be. All right, so that's value. Growth investing, on the other hand, is almost like from another planet. And those of you who are familiar with stocks like Tesla and read analysis that is largely written by people who have a value orientation will say Tesla should be bankrupt, Tesla deserves to have no value, they never make enough cars, they have no profits, etc. And that's because the number one tenet of value is that it's based on growth and future growth. So they look at what the company is at today in terms of its growth, and then there's an extrapolation that is made that this growth is going to continue and often even accelerate, because oftentimes into the first period of growth, most people, most investors, the stock market even tends to underestimate both the magnitude of that growth and how long it's going to go. And as a result, forward-thinking investors or growth investors who are willing to actually invest will see that there's always people who are surprised by both the magnitude and the length of this growth, that they come in and want to buy these stocks increasingly. Or in other times, there are a number of people who are betting against the stock who are then forced to come and buy it in an act that's called short covering. And short in the stock market means that someone betting on a stock going down. So that's the number one big difference between value and growth, is that it is based on current growth and future growth. And the future growth oftentimes is assumed to be accelerating, which is a critical factor for growth investors. And this growth for growth investors is not measured by profits. It's not measured by the assets on the balance sheet or by ratios like PE ratios or price to book value ratios. It's measured really largely by sales growth and accelerating sales growth. So in other words, a growth investor would want to feel that over the next 1, 3, 5, 7 years that a company is actually going to go perhaps from 15% growth to 20% growth to 25% growth to 30% growth. It's never going to be in a perfect straight line. Nonetheless, that looking out 3 or 5 or 7 years, they can feel certain that the total average rate of growth will have seen an accelerating trend. And this is a pretty critical factor as well for growth investors and growth stocks. Sales growth, accelerating sales growth over a long period of time, usually 3 to 5, 7 years. And obviously, when an investor is doing that, I like to tell my subscribers that when you look at the future, and if you're betting on future growth, well, there are really no past financial statements that you can count on because the growth is still new. Tesla is a great example. Until quite recently, when they issued the Model 3, they largely only produced 50,000 or maybe 100,000 cars in their entire life. And yet, even by the time they just begun to sell the Model 3, they were valued nearly as big as the entire car industry. And many people were confused by that or felt that that was wrong, and that should never be, and Tesla should be bankrupt or whatever the objection was. However, the reality is the folks that are investing in Tesla, and we do have Tesla in our Profits Unlimited portfolio, are looking out at the future and believing different things than people that have a value orientation, who are looking at the numbers and say, Tesla doesn't deserve to be a $600 billion company. It should really be zero. It should really be 30 billion or 60 billion. And that's because growth investors, and I'm a growth investor, and I can tell you my thesis for Tesla, which is that I believe that Tesla is going to dominate a minimum of two large and growing industries. One is the industry of autonomy, which is where its car business will eventually turn into. In other words, where the vast majority of cars that it sells will turn itself into robo-taxis, which are a form of mobility that will allow a lot of people today that are unable to afford a car, the ability to get into something that is safe, cheap, convenient, which is always the way innovation travels. It's always increases access at a very cheap point in a convenient way. And that is an industry that is going to expand the mobility market, which today we think about as being about automobiles and cars and then public transportation. However, it's a complete reorientation in terms of how an entire industry is going to really be in the future, which I assign a very high value to, and also a good high probability. And so I believe that the sales are going to be significantly larger, much larger than where they are even today. The second one is in their energy business, where they've got solar roofs, and then they've got this power wall. And then they've also got an industrial battery business, which is in its very early stages of massive, huge growth as we transition from carbon-based energy to using sustainable energy from the sun, from wind, from waves, where we need to store it and then use it when at the point of consumption. And Tesla is a leader in this as well, and it's very early in that business. When you look at both of these businesses and look at both the magnitude of the growth that they can experience and for how long it can persist, that's the basis on which I look at Tesla and say, even at current prices, we would tell people that we still believe that there is significant upside in it. And that is a view that is confirmed by Kathy Wood as well of ARK Invest, who has a very similar mindset and thought to someone like us. So the third aspect of it, of growth investing, is that there is often a reconception of a business, of an industry, of a sector that is very different than the mindset of people that have a backward-looking view and base it on a value way of thinking, which is based on financial statements, which is based on the past. So this is a third element to it. The fourth thing that I would say is that oftentimes growth companies are looking to often recreate an industry, or sometimes just create a brand new industry out of scratch. And a great example of this is space. This is an industry that I've made several videos on that I'm incredibly optimistic, bullish, optimistic, positive, as I like to say, because we're talking about blue sky opportunity here. We sent a man to the moon in 1968. And after that, the space industry has kind of been burbling out there, making small little improvements. And then we had Elon Musk take his PayPal fortune and put half of it into SpaceX, which is now a $74 billion company, which is now capable of sending rockets into space and bringing them back. It's sci-fi, folks. Even when you watch it, sometimes it seems unbelievable. And he has bigger plans, which is ultimately to have a lunar colony and then to have a Mars colony. And if you're watching on YouTube, you can see the progress that's being made daily towards this. So this is the creation of a brand new industry, because someone might look at a valuation for SpaceX and where it has a $74 billion valuation and say, why do they deserve that? And that's because people who are investing in SpaceX look at the potential value of the space industry, of manufacturing in space, of the value of having a colony in space, of the value of eventually colonizing Mars. And for some people that seems funny. However, nonetheless, I can tell you as someone that was laughed at all the time because of early investments in Google and Netflix, this is something that is also quite common as a growth investor. You are going to be laughed at, you're going to be mocked, because generally speaking, oftentimes growth investments never seem sensible, and they never seem something that really lends themselves to the nice, comfortable logic that value does, where you can go back and look at financial statements and then come up with numbers that you can put into Excel and create models very easily. Instead, growth does require you to look forward and think in a slightly different way, to a different way of living, a different way of having these products and services in the economy, and how people are going to be served. So in the end, growth and value represent very different ways of looking at the world. And in my judgment, in my opinion today, this is an extraordinary moment if you are willing to be a growth investor, because we have all of these unbelievable, phenomenal megatrends going on simultaneously, a Lollapalooza effect, if you will, where the benefit of one stacks on the other. And which stacks on the other. And a great example of this is 3D printing in space, where 3D printing and space are rolling along together, each benefiting each other. Chips and artificial intelligence, or Internet of Things and artificial intelligence and blockchain, these are all stacking on each other. So in my opinion, this is a once in a lifetime opportunity to really buy into technologies, products, services, and companies that represent them in their early stages. That's what I believe. And that's why at Bull Profits, we focus exclusively on these America 2.0, Fourth Industrial Revolution, and growth companies. And if you're interested in that, you can check into profitsunlimited.com or check into the links below to follow us. So that's my video for this week. Value versus growth. I believe this is a historic opportunity to buy into growth because of the presence of these extraordinary megatrends that you can invest in. So if you're invested in it, comment below on the megatrends or the industries or sectors that you are interested in, and I will have another video for you next week. Until then, this is Paul saying bye.